I can't stay quiet about this stock anymore. On running is being completely overlooked by investors right now, but I do believe that it's going to be one of the biggest winners of the next 5 years. I've been a loyal customer for half a decade. I've studied the business, I've invested heavily, but what does Wall Street not see? Why is this brand exploding across Asia and this stock is still a buy today? Stick around because over the next few minutes, this could change your mind about on running. Welcome to the Value Investor Show. So, On Running isn't just another sneaker company, it's a premium sportwear brand that has cracked the code on luxury performance and is scaling globally super fast. And in today's video, I'll break down whether On Running is a buy, or I'm going to break down On's latest earnings, what investors are missing, the big opportunities and things to consider, and also what my financial model says in terms of the intrinsic value of the stock right now. So let's get right into it. So I first bought on stock at around $40 in April, right after it tanked due to US tariffs on Vietnam, as well as some uncertainty around the CEOs and the leadership. However, on for those that don't know, mainly sources from Vietnam, not China, and for a good reason. It's geopolitically strategic. They wanted to avoid China's supply chain risk and position themselves where global trade tensions hurt less, which was a very smart move because if you remember, Vietnam was one of the first, if not the first country to call Donald Trump in order to reduce the tariff. So it really shows that it's a smart move and how forward thinking the company is. Now, since I bought the stock at 40.65, as you see, my market value or the market value of my stock is up 28% currently. It was roughly at 40% just a few weeks ago, but it has dropped again. The stock itself is quite volatile, and I think it's also because this is a relatively small market cap company. There have been a lot of investors in the past. A lot of investors wanted to cash out some of their investment, so this is a quite a volatile stock overall. And I think that plays in our advantage because if we see the stock drop to levels that we see are you know are a steal, we will and I will invest heavily again. And for full transparency, I have 5 pairs of one shoes. I mean, to be fair, the product is elite. It has the design, it has the performance, it has the identity. They're not trying to be Nike, they're not trying to be Adidas. They're building a new category, which is performance luxury, and it's working exceptionally well. And I'm a very heavy investor in Nike as well, but Nike is a different beast. Nike is all about the mass market. It's all about selling as much as they can. Whereas On, yes, they're trying to sell as much as they can, but at the right price point, and they're not willing to sacrifice their pricing strategy for the quality that they're selling. So let's talk numbers. In Q1 2025, net sales across all regions were up 20%, but Asia Pacific was up 130% year on year. Guys, that's not growth, that's liftoff. On has only recently entered Asia, and yet the brand is exploding. I've been in their London store and it's packed. Tourists are buying two, three, 4 pairs at a time, especially from Middle East and Asia. And I've even checked out their flagship store in Miami, and I couldn't get any help from any employees because it was so packed and the demand was there. You could feel it, you can measure it. So the company is not just scaling; they're being pulled into new markets by a hungry consumer base. And Asia Pacific is really really huge and a big opportunity for On. I mean, guys, if we think about Asia Pacific, and how concentrated they are in terms of population as well as their stores and the consumer resilience there. Imagine what will happen to the stores in Asia. And just to give you some perspective, I was reading through the earnings report in Q1 2025, and they highlighted that Tokyo, the flagship store in Tokyo, is very much has actually very much outpaced the flagship store in London, which is probably their biggest store worldwide. So imagine what will happen as On will scale up in Asia. And another important bit is if we zoom out, apart from On, Asia Pacific is the single biggest apparel market globally and is growing the fastest. Most US and European brands get 30%, roughly 25 to 30% of their revenues from this region. On is barely scratching the surface. Their revenues is 80 to 90% primarily from EU and North America. So imagine what will happen after doubling revenue year over year in Asia. What will happen in the next few years? As you see on the right hand side as well, we have the global apparel market growth, and it's being apart from the fact that is going to double over the next 8 years. You see how the market share is very much heavily concentrated in Asia Pacific, followed by North America and Europe. So On is very much hasn't tapped where the meat is, where the biggest opportunity is, and I think that's why On is better placed than the rest. So now let's break down product mix. Footwear is still the core, but apparel and accessories are starting to show signs of life. They're up nearly 100% year on year, and yes, they're still very much a small percentage of sales as you see at the bottom, but they're selling at high prices. And here's the key: On isn't chasing volume, they're chasing the brand. They want to be the LVMH of sportswear. They want to be premium, design first, aspirational, and consumers are paying up. It's not only about the sport perspective, it's also about the brand perspective. And On has the strongest brand, in my opinion, right now. And it's more like On versus Lululemon and versus Alo Yoga rather than Nike and Adidas. And Lululemon, for example, is a company that is showing cracks while On is gaining momentum. And so let's talk about financials and fundamentals. In Q1 2025, revenue is up 28%. Operating profit more than doubled, and that shows clean, efficient growth. The only reason why net income has decreased is because of this line right here. FX headwinds. So On is a Swiss company. So when the Swiss franc weakens, it hits earnings, but it's not a business issue. It's a currency noise. So if you think about it, if it wasn't for the foreign exchange gain or loss throughout the last year, we would have almost double the net income if this was to remain stable. And the reason behind this is because if you look at the operating profit, it has doubled over the last year. Now the balance sheet is pristine, zero debt, nearly 1 billion in cash. Inventories are falling as well year on year, which is amazing. It shows that demand is catching up, and I want to repeat, zero debt, zero. That's so rare for a growth company at this scale, and it really is an A-star company. Now, management is guiding for 28% growth this year, at least 20%, 28% growth. So in terms of revenue breakdown, look at this. A linear, almost linear increase quarter to quarter in terms of revenue by business, wholesale and direct to consumer. This is such a healthy bar chart, and we just love to see it. And look at this, guys, by region. As I've said, Asia Pacific is roughly like 15 to 20%. Imagine what will happen as they scale up, and actually if you look at the quarterly here, look at the difference here. So it started from roughly being less than 10% to here being roughly 15% of revenue. So as we scale up throughout the years, we'll see the pink bar chart over here, the pink part of the bar chart increase dramatically, potentially be larger than America's. Now, if we look at what Wall Street thinks, consensus price target are still below my yes estimate. But even for the most bearish analysts, it's very close to the current target. And on average, most analysts do forecast an upside. That tells you something. Even though I never base my decisions on Wall Street, the fact that most of the analysts are forecasting a higher price, it sounds optimistic, it sounds bullish. And so even though their forward P is 56 and it sounds high, by 2027 it's going to be down to 25, assuming that the current growth holds. And if they beat, and I think they will, their stock will get re-rated. Now, the current stock price is at $52. My intrinsic value model, based on a free cash flow and growth estimates, puts fair value at $68. That's a 30% upside. But I always invest with a margin of safety, so my ideal buy range is roughly $34, which is roughly where I bought. I was buying around 38 to 42, which gave me an average of like $40. So would I buy more now at 52? No, I would probably not buy a lot right now, but I'm definitely holding. And if it dips back to somewhere around for the 40s, the early 40s, I'm definitely backing up the track here and I'm definitely buying. So on running in a nutshell is not a meme stock, it's not a hype. It's a real business with real growth and real global demand, and most importantly, a real moat. I do think they have a moat and they're building something long term. I believe in the leadership, I believe in the founders, I believe in the brand ambassadors, the likes of Roger Federer, Zendaya, Ben Shelton, and many, many more. And if you believe in premium brands, in global demand, in execution, I think this might be your next big winner. Smash that like button if you got value from this video, subscribe for more deep dives, drop your questions below, and I'll respond to as many questions as I can next time. Thank you and see you next time.